So the topics we're going to cover in some semblance of order, the auto-enrollment basics, so your pension scheme, what do you need to do to get up and running, assessment and enrolment of your workers, calculation of contributions and the communications involved. Nest pension, we look at an employee life cycle, so employee walks in the door day one, what can he expect to happen in relation to his future contributions to a workplace pension. The Nest portal, what does it look like and what does it do? Delegated access, so we have full use of delegated access to allow us to do everything. As an employer, you would generally have access to the pension as well. Not everyone does. We've sent links out to everyone in the past and they don't always get activated. It's no big deal if we're getting what we need to get. But if you don't have access to your pension through Nest, over the coming weeks and months is something we'd like to arrange to give you the transparency, to give visibility so that you can hold us to account and say, have you done this? I will make the point later on though, hold us to account for things that should have happened, but an awful lot of communications that you receive are pointless. They serve no useful purpose apart from a movement of responsibility from the provider to you. So if we get it, we don't necessarily need copies, but I'll kind of refer to that in a short while. And the uploads and notifications. So what do we do? What are we uploading? Why are we doing it? What notifications do we get? And what do we do in response to those notifications? And then pension management, trying to understand the statutory communications. What is a declaration of compliance, which you will all have completed in the past, and more pertinently, the re-declaration of compliance, which needs to occur every 3 years or so. So are we doing it? Are you doing it, etc. My ePay window, the documents that are available on my ePay window to ensure that everyone has visibility and is able to understand what has happened. So why has this been deducted from my pay? There should be an answer within the document, one of the notices that tells them what's happened and what they need to do. One plus with Nest is that they also give you a very comprehensive joiner pack when you are enrolled to the scheme. So you get lots of information, very clear with Nest, what needs to happen. Some of the traditional pension providers, it's not so clear. They're not necessarily auto-enrollment schemes. They're schemes that have been converted to allow auto-enrollment to take place. They don't always refer to auto-enrollment within the paperwork that employees get. It's not always as clear as it could be. And then the timeline that we're working to, and that you're working to, and that the employee can expect. So they're enrolled, and they want to opt out, what can they expect and when can they expect it? So without further ado, this is the heavyweight section. I think after this it will lighten up, hopefully, certainly in slide terms anyway. So section 1 is looking at the responsibilities, the eligibility, eligible, non-eligible, entitled workers, terms that you will have heard time and time again, but do you know what they are and their relevance to the process? What are the earnings thresholds? Again, earnings thresholds are a very important part of automatic enrolment. Trigger points and earnings bands, and pension scheme types. So not only the type of pension arrangement that's in place, but also the definition of pensionable pay, which we use. So again, it's a very important part of the setup particularly. So here we go. This is the heaviest slide, more words on this one than any other. So Nest pensions, who is doing what? And this is, as I say, some of the employer responsibilities we will be doing. So there is some crossover between them, but in the initial stages, the employer responsibilities, the first thing you would have to do, even before this, you would need to choose your pension provider, and you may or may not have sought assistance from a pensions intermediary, or you might have sought assistance from ourselves, and we may have guided you based on our experience. Or in the early days, we went to used a service which looked at the workforce, looked at the type of earnings, went out to market, looked at various options, and they came back to us and said, for this employer with this set of information, we believe these options are available and these are why you might like to choose them. We then went back to the employer and said, here's your choices. How would you like to go? That sort of distilled it down into less options, made it a little bit easier. The reality of it, as I said earlier, you don't have obligations to make the best investment choices for your employees. You are perfectly at liberty to choose the People's Pension because you happen to like blue, and they do a lot of blue on their website, and you can say, hey, I really like People's Pension, looks good. They sponsor, what was it, Crawley, I think at the weekend had the People's Pension on their football shirts, and that's why I'm going to use it. And your employee, you can't criticize you or complain because you've chosen People's Pension in preference to someone else. And similarly, you could say, really love orange. Orange is a great color, so we're going to use Nest. But as an employer, you're making that choice. Whatever your criteria are, you've made a choice at some point, and it may be, the fact that everyone is using Nest and you've used Nest too. Everybody can't be wrong. That's fine too. You will have then looked at the options and said, what is the best type of scheme for me? Is it a relief at source scheme where tax relief is added to the pension pot by the pension provider and the deduction from the employee is for the net amount only? Net amount only, why not call that a net pay arrangement, the other one? But anyway, because net pay arrangement, of course, is a deduction from gross pay. Makes perfect sense. So you've looked at relief at source, which, as I say, for your general typical business with a cross section of employees and earnings, relief at source is probably the best option. In not offering any other options, Nest has saved itself an awful lot of grief, actually, because the number of times we've taken over a People's Pension scheme or another provider's scheme and the calculation of contributions has been based on the wrong methodology because no one really knows the difference, and the payroll software said tick this box, so I ticked this box. So at least Nest, you don't have a choice. You can still set it wrong in your software, I guess. Salary sacrifice, do you want to offer that option to your employees, either to the whole workforce or by making an active choice to participate through salary sacrifice, or a net pay arrangement, which, as I've said, it's convenient for if you have the bulk of your workers are higher rate, so they're paid more than the basic rate tax threshold. Net pay arrangement will save them the hassle of claiming the tax relief on that additional, the contribution that's being made at 40%. So it will do it automatically. So it is appropriate to some some employers. If we look across our business, in most cases, it's not the most appropriate, but it will be sometimes. Defining pensionable pay. The inception of automatic enrolment, it was basically, they were quite clear on what was going to constitute pensionable pay. And it was the concept of qualifying earnings, also known as banded earnings. And the clue is in the banded earnings title. It's very similar in the way it works to national insurance. There is a band of earnings, the lower band of earnings in which you don't make pension contributions. There's another band of earnings above that where you make contributions. And then there's a higher band of earnings, so similar to the threshold above which you wouldn't pay employees national insurance. Of course, they're not aligned and they are different, all these bands, but the principle is the same. Above which you don't pay contributions, nor does your employee. So that was the concept that was originally envisaged, I think, with automatic enrolment. What they failed to recognise is whilst an awful lot of employers didn't have pension provision in place, an awful lot did. and the bulk of them would have used a more common sense approach and said it's based on salary, or it's based on salary plus bonus, or it's based on salary plus overtime, or a different definition that was different to qualifying earnings. Qualifying earnings is, I think it's the no nonsense approach. You can't get it wrong. If you base your contributions on qualifying earnings, you don't have to consider whether a pay element, an additional pay component that you've added, is pensionable or not. You really don't need to worry, because it is automatically, if it's in the band, it's pensionable. If it's not, it isn't. In the same way, you don't need to decide, well, you do occasionally, but in general, don't need to decide whether something is NI-able. It's part of your pay components, and therefore it is NI-able. It's in that band. Tier 1, 2, and 3 certification are the sticking plaster used to allow existing schemes to continue in their current form. Tier 1 is basic pay. Tier 2 is basic pay plus pay components that you decide are pensionable, and Tier 3 is pretty much everything. So, and within that, you can also you can form any mix and match that you like to ensure that you meet your obligations. There, with the certification, you'd have to certify it every 18 months to ensure that it actually meets criteria that are set in the legislation. So the basic pay that you use must be at least 85% of the total earnings. So it's basically to stop you creating a setup which disadvantages your employees. So it's there to allow the flexibility to do pretty much anything. As an employer, you also can decide whether or not to put a postponement or waiting period in place. You can postpone the assessment of your workforce for up to 3 months, not a day longer, but it allows you, if you expect employees to, some businesses that we deal with, people are coming and going very frequently, and to enroll them into a pension scheme when they're, a bar worker who may well disappear again tomorrow. It allows some flexibility, some time for you to make sure that worker is going to continue. So, it also, obviously, while they're not in it, it will save you money as well. So the employer's contributions, it's a little bit cheaper, but it's also more onerous in terms of the responsibilities and the letters that need to be sent out. So, whether the savings are outweighed by the admin that goes with it. You then need to assess the workforce and enroll eligible job holders. An assessment goes on every time we run a payroll. We're assessing the workforce. We're deciding whether an employee is eligible, non-eligible, or entitled. We're categorizing them. We're automatically enrolling them if that's appropriate. And so that is, although it's under the employer's responsibilities, because ultimately it is the employer who is responsible, that is one of the tasks that you outsource your payroll for, to get rid of that thing that needs to happen every payday. Because software does handle it, but software has lots of flaws as well. There are lots of auto enrollment is a complicated beast. It's not half as simple as it probably should be. So there are lots of places it can go wrong. You have a responsibility to issue statutory communications or notices to all workers at various points in the process. And then you have ultimately you have to pay Nest. So contributions that are calculated need to be paid to the pension provider, Nest or otherwise. Payroll responsibilities, we've got plenty of those as well, with the caveat that we've also taken on some of the employer responsibilities. So we're keeping the Nest portal up to date. That's a fair amount of work involved in it. Someone changes their pay frequency from weekly to fortnightly and fortnightly to monthly because they've decided monthly payroll is appropriate, but we can go through that middle ground to ease the employees, make the change a bit more straightforward for them. That necessitates many changes on Nest, all that need to be timed, precisely, or dealt with in another way, which is more labour intensive. So we have to do that. We have to add joiners. We have to keep abreast of opt-outs. We have to do all sorts of things. We have to upload the feeds at the end of every payroll. We have to manage worker opt-ins and opt-outs. This is your responsibility really, but I've put it in ours because we ultimately make sure it gets done, and we generally do it because we have the payroll information that is required to complete the task. So we do the declaration of compliance and also the redeclaration of compliance. We affect statutory changes. Fortunately, there haven't been any of those in recent past, apart from changes in the AE earnings thresholds. But obviously, first 3 years of automatic enrolment was a phased introduction. So we had to, at the end of every pay year, go through the workforce, move people from one contribution percentage to another, identify the employees who had gone off-piste and done something different, which they can do. You know, an employee can decide to make a bigger contribution, a higher percentage, a one-off. They can do lots of things, assuming you allow it as an employer, because you may not want to get involved in that. You don't have to. You have to provide a workplace pension. You don't have to be a pension manager. We affect statutory changes. We affect employer decisions, employee decisions. So things you've chosen. You may have decided to segregate your workforce, give the middle management, upper management a better pension arrangement. The employee decisions, at the moment, there'll be employees who are taking payment holidays owing to lower earnings through furlough. We're keeping abreast of My UPay window and obviously software updates and employee communications changes to those, and making sure they go out and are hitting employees. What role do Nest play? Nest really, I mean, they do the basics. So they process joiners, they add people to the pension, you know, make people a member of the pension scheme. They process people as leavers of the pension scheme, and they process contributions to the pension scheme. That's pretty much it in a nutshell. They don't check your calculations or our calculations to make sure that the correct parameters have been applied. There are some, depending on how you've got it set up, you can have warnings in place that's, you know, will warn you if your contributions don't meet the legal minimums. But that's about the limit of it. So it doesn't make sure you're doing it right. It's a bit like the pension regulator, really. The pension regulator is there, in essence, to ensure compliance. And by ensure compliance, it pretty much what they do is make sure that money that should be paid has been paid. If an employee should have been enrolled to a scheme and hasn't been, there's no natural way they'll pick that up. You know, I'm sure they do spot checks and audits, but you know, they've become very much a credit controller, and at least at our level. And Nest is pretty much the same, really. It you know, it knows who's in your scheme, it knows the contributions frequency, it knows who should contribute and when. It generates a contribution schedule, each pay frequency, which it then matches to what you submit. So if you submit a pay schedule with a member that it doesn't think is a member, it will tell you that. It will say, no, you can't do that. So you either join them or it's an error. But it doesn't do much more than the basics. So, you know, anyone expecting Nest to, you know, to trawl through and identify errors, it won't. So that's down to us and to you. So the basic flow of a pension scheme, initially you're setting all those parameters, all those initial things that you've decided: what scheme, what type of arrangement, what contributions basis, who's going to be in it, am I going to postpone workers, all those things. So we will have agreed those with you in the beginning. They're in the software effectively, so we don't do it every 1 month or every week. It's there day one. and it's the basis on which we do everything. Much like you put tax tables and NI tables are updated once a year, you don't look at them again. You're then assessing and enrolling. So, the major, the way you see what is happening is because workers who weren't in a pension 1 month become a pension member the following month. And that's because every time we run a payroll, we're assessing the workforce, and we'll talk about assessment in the next slide. And we're enrolling depending on where they've, how they've been assessed. Then if they become a member, we're going to calculate contributions. We're going to generate necessary statutory communications. And when the time comes, we'll do it all again, because re-enrollment every 3 years or so, and I use 3 years or so, it's not a precise date, it's 3 years from, it's 3 months either side of the anniversary of your staging date. So it's around about 3 months, but there's flexibility within that. So, and it all starts again. So someone who wasn't in the scheme 3 years later, they may have chosen to opt out, you will then re-enroll them and they'll have to opt out again, which is usually a source of frustration to employees. Oh, I told you before, you knew I didn't want to be in the scheme. Well, yeah, sorry, but government demands that we do that. So that's the basic flow. Wow, there's a load of stuff here, isn't there? So the critical decisions that we've already made, I think we've already come across these almost on previous slides. So the scheme type, is it relief at source? The relief at source scheme is pension is deducted from an employee's net pay, so after tax and national insurance have been deducted. And if you're contributing under the AE qualifying earnings basis, these percentages apply. If you've chosen one of the other tier 1, tier 2 or tier 3, the percentages will vary. They're designed, to make sure that if you choose a different earnings basis, ultimately it comes out about the same. So you can't use one basis in preference to another to avoid contributions. So 4% employee, 1% government, because automatic enrolment qualifying earnings, the contributions are 8%, of which the employee must contribute at least, the employer must contribute at least 3%. So they can contribute more if they wish. And then the balance must be contributed by the employee. So as an employer, you must contribute at least 3%, and the employee will therefore be contributing 5%. If you chose to contribute, as some do, 4%, they'll be contributing 4%. And after tax relief, that would be, 3.2%, 3.25. I haven't got my calculator. So that's a relief at source scheme. So the employee sees the net amount deducted from their pay, it goes to the pension provider, Nest, and they then add the extra 1% or another 20% of the amount contributed to that employee's pension pot. So when they see their pot, it will be bigger than the amount that they saw on their payslip, which is the government contribution. So the employee's got to be a winner, really. The employer is making a contribution, the government's making a contribution, and they're making a contribution of only half. So it's a good thing. Net pay arrangement, I've already said, particularly relevant and useful for workforces with predominantly highly paid employees. It just saves them the admin of claiming that tax relief. It's not a hard thing to do. You phone up HMRC and say, I contribute pension, make pension contributions at a higher rate, and they then adjust your tax code accordingly. So it's not a difficult thing to do, but you really want to do it. So higher earners, they'll see the full percentage deducted from their pay. They won't necessarily spot the tax relief. So, if you saw the two pay slips side by side, it would look like that employee was contributing more. Ultimately, they're contributing the same, but in a different way. And then salary sacrifice. The benefit with salary sacrifice is the tax angle is the same either way, but with the salary sacrifice scheme, you also get the benefit of a reduction in the national insurance that you're paying, as does the employer. So there's a NI saving there made by both employer and employee. An employer will sometimes give that to the employee and sometimes will keep it themselves. That's up to them. But it gives a saving, but it's an extra layer of having to explain exactly what you've done. It isn't right for everybody, which is why across the employers we deal with, it does tend to be avoided. And anyone who had experience of dealing with furlough calculations involving salary sacrifice would have never chosen salary sacrifice again, because it is ridiculously complicated, because it reduces, or in that case, it reduced the pay you use for furlough calculations, and you couldn't claim as much. So it was, although it all comes out in the wash, it was the devil's own job. Of course, that only mattered when you were claiming pension back. So what is pensionable pay? So under AE qualifying, pensionable pay is most things, really. You'll find most things there. It'll be salary or wages, commission and bonus, overtime and piece rates, shift allowances and call out, statutory and contractual sick pay, holiday pay, parental pay, everything. There's one exception, which is if car allowances you can exclude from the AE qualifying earnings calculation, but that is the only exception I'm aware of. And you add everything together and the pension is calculated on a band of earnings between 6,240 for the current tax year and £50,000. So there's a maximum that you can pay. So an employee can earn, £200,000 a year. Your contribution is capped at as if it was £50,000. So it may not be that the appropriate way to reward workers who are highly paid workers within your business, who your business hinges on. AE qualifying earnings may not be creating that value in the package that you'd anticipated it would. So you need to be a little bit careful about it, but in general terms, it works for most people. And if it doesn't work, you can choose tier 1, tier 2, or tier 3 certified schemes. You can create a scheme that achieves the objective you want to achieve. But as I say, the percentages can vary depending on what you've chosen. You can segregate part of your workforce so that part of your workforce is using a tiered certification and part is using AE qualifying earnings. You can structure it so each employee is a group on their own if you so wished. There are lots of things you can do with a pension scheme. They'll create complications and difficulties, but there are lots of things you can do to make a scheme attractive should you wish. An important thing to mention there is that all these things are, they're being controlled by you and not Nest. So Nest they provide the vehicle by which the contributions are contributed to an employee's pension pot. But you, and in association with us, if you decide to make a change that rewards your senior management team with a larger pension contribution, that is something that needs to be managed outside of Nest. Nest won't manage it. So, which is why, if someone comes and asks us the question, can we do this? The answer is almost always yes. I mean, it's always doable. But you've got to tell us, some people will talk about their employees contacting Nest and or their other alternative pension provider. No, that's not going to help. They need to tell you what you want, what they want you to do. You relay it to us and we make sure it happens. And then it all works pretty well. So first step on the journey, we set everything up, everything's working well. We know we've answered all the questions. I refer to it as knowing the rules of the game. We know what we're going to play. All we need now to do is to decide who is going to play the game. And that's where assessment comes in. Assessment is something that you need to do every payday to ensure that workers' earnings are looked at. So with assessment, we're looking at employer set parameters. So for example, if you put them in a scheme day one, a contractual scheme, which fulfills automatic enrollment. So if you put them in a contractual scheme which doesn't fulfill automatic enrolment criteria, they will still be automatically enrolled. So, you know, we quite often get people who have arrangements outside or want to put arrangements outside, and you know, we say you can do what you like, but you're not in control of that external scheme necessarily. So an employee, you know, would like to contribute to that fund that they've contributed since they left school. We would caution against it because, you know, you're not in control of it. There's an awful lot that can go wrong. All you're really doing is acting as a collector and a payer, and there's no reason the employee can't set that up directly. And it doesn't diminish your responsibility under automatic enrolment. So if you say Fred's got a pension with Virgin, he's had it since he was, you know, 12 or whatever, doesn't matter. It's not a qualifying scheme as far as we know. We're not in control of it, and they will be assessed as if it didn't exist. So if we have those schemes in the background, we've, you know, made a, you know, we will have marked them as not qualifying schemes, and they just don't have any relevance to the process. So they may have joined a qualifying scheme, that's fine. And everyone else who isn't in the scheme, every time you run a payroll, we're looking at their age and we're looking at their earnings. And as I already mentioned earlier, directors are a different breed, so we'll kind of forget about them. If they don't have a contract of employment, they don't exist for AE purposes. If they do have a contract of employment, then they would be a worker dealt with in the same way. But assessment is, you know, looking at age, looking at earnings, and then categorizing the worker on the basis of, you know, what that assessment is, the results to that assessment. Having assessed them, there are three groupings or one of three categories they'll fall into, unless they're really old, really young, so under 16, over 74, then they're, at that point, they're not a worker for AE purposes, and you know, they won't form part of the process. Everyone else will be categorized as either an eligible job holder, which is the category of worker which is automatically enrolled at that point in time, and a non-eligible job holder, so they won't be automatically enrolled at that point in time, and an entitled worker who is also known as a worker without qualifying earnings, which is a bit better than entitled worker. Entitled worker sounds like they're entitled to something, which they're not really. So a worker without qualifying earnings. So there are those three categories of worker, and we'll look at, and as I say, we do it every pay run. It's part of the process, and they will fluctuate through time. So an employee may be an eligible job holder 1 month, a non-eligible job holder in the next month, depending on where their earnings sat. And basically, once they've hit the high point, so once they've become an eligible job holder, at that point, you know, you don't need to reassess them. They're at that stage. If they're entitled worker, you need to keep assessing them. If they get to non-eligible job holder, a different set of obligations kicks in. And if a non-eligible job holder subsequently becomes an eligible job holder, again, new obligations, new duties, and we need to administer those. Earnings thresholds, quickly skate over these. These are relevant to the process. Looking at weekly and monthly, so the top and the bottom really. These, and in the next slides, you'll see these are relevant to the categorization of workers. So they're the qualifying earnings above which an additional duty may apply. So again, much like national insurance, above a specified figure, national insurance is paid. Below it, it's not. Very similar with these, a little more complicated. It's more three-dimensional than national insurance, which is why it's really difficult to put in a picture or on a slide. It's you're looking at 3 dimensions. So we've had to try and describe it in words, which we will now endeavour to do. So eligible job holders. An eligible job holder is an employee who must be automatically enrolled and so they're between the ages of 22 and state pension age. State pension age used to be quite straightforward. Then it became quite complicated because people would hit state pension age at the age of 65 and 11 months or something daft like that. It does seem to come back into alignment now where it often sits on a birthday, and I guess ultimately it will. But wherever that sits, that is the point that's important. So to be an eligible job holder, you must be between the age of 22 and state pension age. And you must earn above the earnings trigger for automatic enrolment and working or ordinarily working in the UK. The earnings trigger for automatic enrolment is and has been since day one £10,000 per annum. Obviously, that's subdivided into the pay frequency. So £10,000 over 52 for a weekly frequency, £10,000 over 12 for a monthly pay frequency, and so on and so forth. So that's never changed, strangely. Everything else around it has moved. There have been changes in contribution rates. There have been changes in those automatic enrolment qualifying earnings levels, but this one hasn't changed. And I think they originally said it would make life too complicated. I'm sure at some point some bright spark will say life's not complicated enough, let's change it. Because obviously it's gradually falling behind where it would. Although I guess if you leave it that way for long enough, then eventually everyone will be in it. Which is probably the ultimate goal. So yeah, maybe you don't move it. So the minute that they're assessed as an eligible job holder, you must automatically enroll them, and you must put them in the pension scheme, and you must make employer contributions on a regular basis. So that is why from time to time an employee who hasn't made a pension contribution suddenly makes a pension contribution. They may have hit the age of 22. They may have, their earnings may have increased, may have increased their hours or whatever. They've hit a critical point, and therefore they've been assessed as an eligible job holder. You find differences of opinion over whether an employee can opt out before they've been automatically enrolled. Some pension advisors will tell you that they can opt out, they can state their wish to opt out before they've been automatically enrolled, which I guess makes some sort of sense. The pension regulator takes a different view, or seems to. He takes the view that in order to opt out of a scheme, you must have been in it. And the best way to prove an employee was in it is for it to show on his payslip, for him to have had a deduction made. That way he's seen the effect of that deduction, he's assessed whether it's affordable, something he wants to continue, he's made a considered judgment about what he wants to do. If ultimately he opts out, that's his prerogative. Whereas if he was never in it, you get to the point, well, there's no actual proof he was ever included, a deduction made. Did he realize the implications of this? So certainly pension advisors have different views. I've heard them all. The pension regulator view is pretty clear. I think we certainly do it on the basis that we will make those we won't accept an opt-out notice before it's happened. With Nest, and actually, I'm kind of talking about other pension schemes here, because Nest, they have to be in it because they have to opt out through Nest. They can't opt out with you. They can't, they can opt out by Nest. They can obtain an opt-out form from Nest, give it to you, but without being a member of Nest, they can't possibly opt out. So in actual fact, with Nest, that's not an issue. It's an issue with other schemes though, where people, were they in it, were they not in it? So another advantage of Nest, I must remember that one. Non-eligible job holders. Non-eligible job holder is aged between 16 and 21, so he hasn't hit, he doesn't, he's not over 22, so he's kind of next tier down in terms of his age. Or he's over, so you've got the middle ground of 22 to state retirement age or state pension age. I call it retirement age, but it's not anymore, is it? A non-eligible job holder, he's in a different grouping. So he's either aged between 16 and 21 or between state pension age and 74, at which point he's no longer considered a worker. And he has qualifying earnings above the earnings trigger for auto-enrollment. So actually that's earnings threshold for auto-enrollment would be the correct, I think, let me get that right. Yeah, auto. Yeah, it should be all threshold. So he's not over 833. I think he's over. Yeah, yeah. So it's not the trigger. It's the right figure, but it's the wrong description. Or he's aged between 16 and 74 and has qualifying earnings between the lower earnings threshold and earnings trigger. So he hasn't hit the trigger of £10,000 per annum, £833 per month. So he's either not hit the criteria on the basis of age or on the basis of earnings. So he's fallen short of one of those hurdles. That being the case, he's assessed as a non-eligible job holder, and he can ask to join your pension scheme. And if he asks you, you must enroll him, and you must do it at the next available pay period. And you will also have to make employer contributions on a regular basis. So if he chooses to join, you have to make contributions as required by legislation. The third category of worker is an entitled worker, and he's basically everyone else. So aged between 16 and 74 and has earnings less than the lower earnings threshold of £520 per month or £120 per week. So he is, as I say, an entitled worker. He's not entitled to anything. You just basically have to put him in a pension scheme if he wants to be in a pension scheme. So he doesn't need to be automatically enrolled. He can ask to join your pension scheme, and he must be enrolled on request, but you do not have to make any employer contributions into the pension unless you want to. As with all things, you can do more than the legislation dictates, but you can't do less. So that's the three categories of workers that you come across from throughout. And obviously an entitled worker can move to being a non-eligible job holder. A non-eligible job holder can move to being an eligible job holder, and it's always that top. If they're assessed at a higher level, if you like, then things change. If they're assessed at a lower level, then things don't change. So they continue at the level at which they were assessed, at the higher level. And higher level, I'm not sure is the right term, but the category with greater obligation, I think, is probably a better term. Contributions. So after the phased introduction, when it was various. It was 1 year at 1% in 1% employer plus 2% employee, and then another year at 2% employer plus 3% employee, and then it's currently, and has been for 2 or 3 years now, 3% employer and 5% employee. As I say, that's the caveat with that, is that's for a worker where you're using automatic enrollment qualifying earnings or banded earnings as your definition of pensionable pay. Other percentages may apply if you've chosen a certification route. It may be the same as that. So if you basic pay is those percentages. You can also use tier 2 certification if you I tell a lie. Basic pay is higher percentages. I don't know off the top of my head, 5 and 4 I think it is, but you can use the tier 2 certification with the same earnings basis as tier 1, and then you can get away with the same contributions, which is not in the spirit really, but it is allowed. So you can and you find pension advisors do it quite often. Actually, they say tier 2 certification, but they're only actually using basic pay as the pensionable pay, which is perfectly acceptable but cheaper. A graphical. This is the lighten the burden really. There's been loads of words and it's just like mad, isn't it really? So Tracy stuck a pie chart in here. Brilliant move. I love it. She had loads of pie charts in, but I couldn't make them all work. It's really to demonstrate the importance of the employer contribution at 3%, the light green, and the government contribution of 1%, the the darker green. So, the fact that an employee is only contributing 4%, but is getting 8% of benefit, it really should, if an employee is serious about saving for the future and starts young, which is why there's now talk of that age 22 being lower than 22, coming down, so that more people are captured, more people are eligible job holders earlier in their working lives. Because obviously pension is about starting early, isn't it? You start early, your pot builds much quicker. If you start late, then you need to put astronomical sums in just to create a pension pot that will pay for the daily pinter or whatever. So that's a graphical interpretation of the, as I say, 1% added by the pension fund. So the employee sees 4% on their payslip. And the difficulty with auto enrollment qualifying earnings is, much like it's like tax and national insurance, really. People will probably be vaguely aware that tax is at 20%, but they'll look at their payslip and say, well, my tax is only 12% because it's not on all of your pay. Same with national insurance, and the same with pension. If you tell an employee they're contributing 4% and you don't make it clear 4% of what, they'll do the calculation. They'll say, well, I'm not contributing 4%, I'm contributing something different. And the importance of recognizing that it is a relief at source scheme is important. I've had many a panicked phone call from pension advisor, auditor and company directors saying we're below the legal minimum, we're only 4%, and it's 4% is a relief at source scheme, therefore you're adhering to the legislation, don't worry about it. Tell your auditor you really ought to get a handle on how pensions work. You can come along if you want, we don't mind. So the areas we're going to look at are the employee life cycle. So as I've alluded to before, an employee who has joined you, what can they expect, or what should they expect throughout their life with you as a business? So what will they come across and when? A brief look at the Nest portal and communications. I'll probably have a rant, get on the soapbox, because I tend to do that at least once every webinar. I might choose that one. Delegated access and notifications. The workflow, so how it all hangs together, workflow and timeline. There are auto enrollment is all around time. When you need to do something, you must do something by this point in time. So just looking at some of those critical points, really, and some of the less critical areas that what you can expect us to do and when you can expect us to do it. And then a very brief look at re-enrollment. Happens to us every 3 years, so we need to mention it. It is one of those, it is one of the busier years, I think, this year for re-enrollment. So it must be the 3-year or 6-year anniversary of when the general bun fight began in terms of re-enrollment. So we'll move on. So employee life cycle. So we got a starter, and I've tried to identify the key points in time at which something happens, and I'll briefly describe that something, and hopefully it'll make some sort of sense to someone who's looking at a worker coming into the business and how it will work. So the first thing that I've got there is assigning a scheme. Now, for some, you've got one scheme operating on one basis, not a problem. They're going to go on that default scheme. I think, if that's the way you're operating, your Nest setup, I will have called it AE default scheme. It is the one and only, and therefore you've got no further work to do. There are certainly people who are attending the webinar currently who have more than one scheme in place. There's one business that I know has preferential arrangements for certain members of staff, be it seniority or longevity or whatever. And then there is another employer who has a couple of schemes, one with Nest, one with someone else. So you need to assign, or we need to assign, the right scheme to the right individual. And that needs to be done regardless of their status. So even if they're a 16-year-old coming on a work experience, they're there, you don't anticipate them being there for long. Regardless, part of the checks and balances that we have to carry out, we need to assign a scheme to them. They will become a worker if they're not already, and we need to know which scheme they will ultimately become a member of. So it's not included on our starter forms because it is quite unusual, but you will find us potentially coming back and saying, which scheme was it? I mean, we've got employers with half a dozen different schemes in place, and we need to know which scheme they belong to. Some will have clear rules, over £30,000 scheme X. Others will have less well-defined criteria. So that's the first step of the process. Before we can do anything, we need to know which scheme they're going to be a member of. Depending on whether there's a postponement period in place, if there is a postponement period in place, what a postponement period does is delay the inevitable assessment of your worker. But in delaying that assessment of your worker, you need to tell them, A, that you're delaying the assessment of their delaying the assessment for a workplace pension. And you also need to tell them that if they want to be a member of the scheme, then they can be. And that's obviously the critical part of it. So postponement, very common. I think more employers postpone than don't postpone. But if they postpone, then they need to get that step one of the communication process saying, we have postponed you, you can join if you want to. So we then carry out the employee assessment. So we may carry it out day one, or we may carry it out at any point in time up to 3 months. So you can postpone for up to 3 months. So it may be that that assessment is delayed for 3 months, but it will eventually occur. Having carried out the assessment, we generate a second communication. I've called it letter 2. If it is someone who hasn't been postponed, it will actually be letter 1. So I've created some confusion there, but it's letter 2 in the set of letters, but letter 1 to that employee. And that letter will tell them whether they're eligible, non-eligible, or entitled. So they've been assessed as, and it will tell them they've been assessed as. It will tell them either they've been enrolled or they haven't been enrolled. It will provide details of what auto-enrollment is and why it's happening. And it will provide answers to some questions they might have about automatic enrolment. It will give them information on how they can opt out if they wish to. And in the case of a NEST scheme, that will be with NEST. So the timing of all of these, and I talk about it in one of the later slides, the timeline is one of the difficulties with all of this, really. If you get that letter out too early, then an employee can be trying to opt out of a scheme with NEST, because it will tell them they can opt out with NEST. They'll be trying to opt out before they've been enrolled as a worker with NEST, or as a member with NEST. And if you tell them too late, it refers to a timeline which the letters tell them they've got 30 days to opt out. And actually they haven't, because NEST have had them on their books for a week or 2 weeks, and so NEST think they've only got a lesser amount of time. So the timing of those communications is important. If you've got to get them synchronous, you've got to make sure that synchronous is right. They're about the same time. It doesn't work otherwise. So that's quite important, and it's one of the reasons that you probably do it after the fact. Once the payroll is closed, you're going to then deal with the communications as a group, rather than dealing with them immediately. And that creates a problem, because an employee's already got a pay slip showing a deduction and is wanting to know the questions, answers to the question why. So there are timing issues, which is why the broader issue of education and talking about pensions is important. If an employee knows that they've joined the business. If they've been postponed, then the postponement letter will refer to it. They'll know it's going to happen. So it's probably another good reason for postponement. But if they haven't got that, it's suddenly happened. You can't tell them to opt out because Nest don't know they exist. And it's just important that those things are dealt with in the correct timeline. So at the appropriate time, and bearing in mind the timeline, we're then going to update Nest with the joiner details. So we will upload a joiner file to Nest saying that this worker has become a member. It doesn't tell Nest anything more. It doesn't tell Nest whether they've, actually it does, because you do determine it. So it's up, broadly it tells Nest whether they've been automatically enrolled, whether they've opted in. So they may have received postponement letter and decided they want to become a member immediately. So opt-in is another categorization that Nest have, and Nest have a catch-all other categorization. So if they were joining as a contractual member, then they would be captured with that. But it's also important that that categorization reflects the way your business is working. So if they're automatically enrolled, they have a right to opt out, and Nest reflect that in their communications and the way they work. If they join as a contractual joiner, then they don't have a right to opt out. And more importantly, they don't have a right to have contributions they've made returned to them. So if you've told them they're going to be in it and they think they then have a choice, they may have a choice, they can come out at any time, but they may not get the contributions back that they paid in initially. So, it is better to go with the automatic enrollment option than put someone in the scheme, as one client who isn't here today puts them in the scheme, doesn't tell them that, and then they want to come out and they lose those contributions, or the employer does, because the employer often says, oh, we'll pay for it, kind of thing. So it's just important to to realize what you're doing. Nest send a welcome pack. Nest send that. They allow 3 working days to send it from the point in time when they're uploaded by us to the point in time when that pack goes out. And then they have a further 30 days to opt out. So they get their welcome pack. The welcome pack tells them an awful lot. It's about 30 pages long, I think. It tells them all about the pension, what's happened, what is Nest, how to log into their account, how to opt out if they want to. So it's a very good guide to use in Nest. But it's only good if they open it and read it, of course. And as we all know, and I'm not one who don't do it myself from time to time. If you don't open it, you don't know what's inside. You can easily miss a 30-day clock ticking away and find that you've left it very late in the day, or you've left it too late. So, the letter they get initially will tell them that they can expect it. It will tell them they're going to get a joiner pack, but they need to look out for it. More importantly, they need to act on it if they want to opt out. They can opt out. There are, I think, 3 routes by which they can opt out. They can opt out directly on the portal, so they'll have a user ID login, or the usual paraphernalia that goes with an electronic portal these days. So they can use that method. They can phone up, and they can do that before they've got their joiner pack. So, if we've sent the letter and we've made sure that the synchronicity is correct, and therefore Nest know about them, they should be able to pick up the phone, contact Nest with their national insurance number and say, I want to opt out, and be able to do so. And then the third option is they can request an opt-out form from Nest. Nest will send them an opt-out form, and it has a unique reference. They can then fill that in, give it to their employer. The employer would then need to pass it to us. We can enter the unique reference and action the opt-out through Nest directly. So there's 3 routes by which they can opt out. If they choose to opt out, Nest will tell us. So they will tell us that that employee has chosen to opt out. If they've missed a deadline, they'll tell us that that employee has chosen to cease making contributions. So they'll tell us either way. Whether it's an opt-out or cease making contributions will determine whether or not a refund is processed. We'll make the necessary change to our software. and they will then be marked as an opt-out or a scheme leaver until the next re-enrollment date comes along. If they haven't been assessed as an eligible job holder, we'll continue to reassess the worker every pay cycle, and we'll then, if their status changes in an upward direction, then we'll issue letter 3 or letter 4. So potentially an employee could get 4 letters. They could get a letter 1 telling them they were postponed. They could get letter 2 telling they were entitled worker, and what that meant. They could get a letter telling them after that they were a non-eligible job holder, and then they could finally get a letter telling them they were an eligible job holder. At that point, they won't get any further letters because they've reached the top of the tree. So potentially 4 items of communication there that need to happen, with an additional communication from Nest, which gives them 2 bites of the cherry, 2 opportunities to see the communication and opt out of the pension scheme if they want to. So that continues at around 3 years after the staging date, or after the previous re-enrollment date, if there is one, which there are in some cases. Then we will carry out a re-enrollment. We'll look at those employees who are not members of a scheme, who have left or who have opted out more than 12 months previously. And if they are assessed at that point in time as an eligible job holder, they will be re-enrolled. It's a one point in time opportunity. It's not like the normal enrollment process where you keep assessing them until they get to the peak of the mountain. In this case, one time only, re-enrollment. At that point in time, they are what they are. If they're assessed as entitled or non-eligible at that point in time, then they will continue to be assessed. If they're eligible job holder, they'll be re-enrolled. But if they, what am I trying to say here? I've lost it. So it happens on a specified date. So those people who are eligible to be re-enrolled, it's a one-time only opportunity. If they're being assessed and reassessed as part of the general assessment process, then that will continue. So it's just those, potentially that group of workers who you're looking at for re-enrollment. You pick a date, and at that point in time, they're either in it or they're not, and you don't have to continually reassess those who have left or opted out of the scheme. Hopefully I've clarified that. And the process continues. Re-enrollment will happen again in 3 years' time. Little look at the Nest portal management. Some of you will have seen this, some of you won't. It's not very exciting, and when people have delegated access, we take great pains to say don't do anything with it. We've had examples where people have Nest creates contribution schedules. So every month the contribution schedule is created before the point in time when it's due. We then upload to that, and any mismatches are dealt with and result in an error. So those are created, but they also provide an option of choosing the same figures as you used last month, which people can look at it, get a communication from Nest, think they've got to act quickly, and suddenly they find themselves paying for 3 months, 3 months pensions unadjusted, and it's not quite right. So Nest Access, the employer, ultimately it's their account, they can do what they want really, but we tell them not to. Please do not start messing about with your Nest portal. By all means, look at it. You will get emails from Nest telling you what's going on. Be aware of it, be aware of the potential things that can go wrong, but if we're managing it, you don't need to. So just bear that in mind really. We will have delegated agent access. It's full user access that we insist on. It allows us to do everything. So we can upload contribution schedules, we can upload joiners, we can make changes to worker groups, we can make changes to bank details, contribution groups. We can do everything. Which is what we need to do, really. We can't, can't not be able to do things. And the employer, the employer details will be entered on Nest. You have to enter them in order to set up an account. And at that point, a link would have been issued to give you delegated access, but often, they're not acted upon for whatever reason. If you've got an account and you haven't seen it and you want to see it, we can reissue those delegated access requests, and you can have a little look. But yeah, I mean, it looks something like this. Yeah, if you're 13 in your mailbox, you're all right. That's a standard month, I reckon. I looked this morning, 165 emails in my mailbox, and I took a quick list of the type of communications that were in there, which are on the right hand side. So we got everything from and I've listed ones in red that I think you should be acting upon, looking at, questioning and saying what on earth's going on here, as indeed we would. Bearing in mind, we get all of these. Any email you get, we get. So we get an email and we can go on at any time and get an overview that, that shows if anyone's got contributions overdue or anyone's been reported to the pension regulator. So that's just as I say, 165 emails. I get millions of emails. We just get hundreds of them. They're far too many. We get the important ones. We've reported you to the pensions regulator, which I hasten to add is an employer who ceased being about 12 months ago. One thing you can't do with Nest very easily is remove yourself as a user. So unless someone else has taken over your you can do it as an employer. You could take us off. You can say don't want Cox Co looking at it anymore. But Cox Co as a delegated user can't take anyone off at a higher level. So we end up ultimately with some rogue accounts that shouldn't be there, which is useful when I'm trying to look at messages that you might see. So we've reported you to the pension regulator. Deadly serious. Urgent action is needed. Overdue contribution schedule. That's clearly an urgent matter that needs to be dealt with. There are things that can happen that can lead to that error message happening, which is not a problem. So one common one is where you might have an employer who is not included on a schedule, is subsequently processed as a joiner, but because they joined you in the previous pay period, they've got an earlier start date. Even if you've processed a schedule, they can pop up on a previous schedule. They will pop up as someone who needs to be actioned. If you don't spot the fact that that has reappeared as a schedule, then it will eventually lead to an urgent action is needed overdue contribution schedule message, at which point you ask the question, what on earth's happened there? You mark them as a zero contribution, no contribution is due, and it disappears. I think all the pension providers have a similar kind of, can have similar issues, because schedules include people on the payroll at that point in time. If we, for example, processed a leaver in a previous pay period, because it's not included in your schedule as a leaver this pay period, the provider wouldn't know they'd left. And it would say, why on earth is that person not on it? And it will generate an error message of some description. Different providers have different error messages, but they all ultimately warn you that we're expecting a contribution. We haven't had one. You need to tell us why, or we might report you to the pension regulator. And there's a problem with your direct debit mandate. That's, again, a pretty serious one that leads ultimately to overdue contribution schedules, and we've reported you to the pension regulator. We've had clients who cancelled the direct debit when the pandemic first landed, hasn't got to a point where they've reinstated it. You can only pay Nest by direct debit or by credit/debit cards. You can't make a BACS payment or electronic payment from your bank. One of the missing links, really. I think, you know, you'd expect to be able to make a payment by BACS to rectify a shortfall in contributions, but you can't. You can set up a direct debit, but it takes 10 working days, and so you can end up with a shortfall for a period of time. So those are the three that in my inbox. I thought I think the inbox covered most things, so they're pretty dodgy. Then you get the next in the list. I've done them more or less in order of importance. Details of workers who've opted out of Nest. So you get a notification to tell you someone's opted out. Obviously, you need to action that through payroll, or we do, I should say. We need to make the necessary changes, make sure contributions are refunded, etc. And we also need to be aware, because those opt-outs, if we've already prepared a contribution schedule which includes that employee, when you upload it, because they've opted out, it will generate an error. So it's good to know that that's happened, so that we can be ready for the error, or take them out of the file before you do it. So that's important. Member wants you to stop making contributions. Again, that's important. There's no refund to be administered there, but there will be a date beyond which contributions shouldn't be deducted. Again, Nest will reject it. So if it knows someone shouldn't be making contributions any longer, it will reject any contribution you try to make, which is a good thing. It alerts you to the fact that something has happened with that employee. Other pension providers I know will continue to accept contributions for people who are no longer members, which I think is a bit daft, and then you have to go through the rigmarole of pulling it back, making sure you've got your refund, etc. So it's quite a good thing. We need the current address for some of your workers, so at some point item of mail has been returned, probably not known at this address, so we will potentially ask you for an updated address for that worker, being aware that it may well have changed. And then you get the we're confirming setup of your direct debit mandate. That's again an information thing. The bottom two are the ones that you get fed up with seeing. We're confirming your direct debit for payment source, so it tells you that the direct debit that you've processed is going to happen. You know, I mean, it will be paid on the 21st of the month, but you get an email to tell you that it's going to be paid or has been paid. And your contribution schedule is ready for payment source. Again, you wouldn't need to know that as an employer, but you'll get an email to tell you that it's happened. What that means is that for now, currently in January, it will tell you that the February schedule is up there, ready to go. It will amend it and add joiners if someone is added in January. So it's not cast in stone, but it is there, ready for amendment and submission. So that's kind of typical bits and pieces that you get. You get email overload with Nest. You just get loads of emails, and as you know, the more emails you get, the more difficult it is to pick out the email that is important. But yeah, you can get to recognize the ones that need action in immediately, and the ones that you can just delete. You have a choice with your emails. You can archive them, or you can mark them as trash, but nothing is ever deleted. It's always there forever, so you can't get rid of it. It will always be there. Pension portal workflow. So this is really what we're doing and when we're doing it, the things that we do for you. So the things that we do when a payroll has been run and closed, or as part of the closing process, we'll create a joiner schedule. So we'll generate a CSV file that includes details of any pension joiners for that pay period, and we will pay in regard to the timing issues. We will upload it to Nest. We will also create a contribution schedule. So, again, a CSV file that details the contributions and pensionable pay for every employee who is paying pensions in that pay period. and it will also include anyone who is not paying pensions in that pay period with a reason code. So for example, their earnings may have been too low, they may not have been paid, they may have left, so that file will include that information, and we upload that to Nest 2. And at that point in time, we reconcile the figures on that, the figure on that submission with the payroll reports that we would have sent to you at some point. Different people have different pay reports. So if you have a payroll journal, or you journal things into your payroll software packages, you'll all presumably have a pension control account of some description. And in essence, we'll be reconciling with that figure to make sure that what we pay is what is expected to be paid. That is at that point in time. We will have taken account of any opt-outs, so your payroll reports may show negative figures for refunds, which you will also have to, you always have to take into account. You may, on occasion, the contribution schedule may change in the period of time between when we upload it and when it's processed to direct debit, because someone may have opted out after we'd uploaded it, but before the direct debit is processed, Nest will then remove it from the schedule. So although we reconcile it at that point in time, it is always possible that the figure we've uploaded is different to the, to the figure you see on your bank account, because your bank account will be the direct debit, whereas ours will be what it was at that point in time. So it is, as kind of as an accountant or having accountancy in my blood, reconciling your pension control account is a key part of the process. We do everything at our end to ensure the correct figure is paid across. There are checks and balances along the way. We can't upload contributions to an employee who's not on the pension scheme. The pension feed is generated from the payroll software, and therefore, it's unlikely, if not impossible, that it doesn't reflect what actually happened. But nonetheless, you will undoubtedly, if you have auditors, they'll be asking, in July, why was this figure paid? In actual fact, it should be that. And you always need to look at opt-outs. Opt-outs are the key to most of those discrepancies. You'll find a difference, and it's because Nest have refunded some money to you, which you may not have allocated correctly to the pension control account. Maybe it went somewhere else. Someone didn't actually know what it was and put it in, I don't know, wage costs or somewhere like that. So, just like your PAYE, really reconciling it as part of your monthly process is an important thing to do. So we're also managing employee details to a degree. We're managing employee details in terms of their worker group, their contributions. We're certain things. We're not, importantly, we're not managing the address. Nest, again, some pension portals allow exchange of information, address information. So again, the ones we deal with most frequently, Nest, People's Pension, and Aviva. Nest and People's Pension have pros and cons. They're both, both of them have things the other doesn't have. Aviva is a bit behind, but is kind of catching up. But one thing that Nest doesn't do that People's Pension, for example, does, People's Pension uploads address details for every employee every time you process a pension payment. So if you've changed that employee address, it will be changed on the People's Pension. If you've changed the address with payroll on the Nest pension, it won't have changed. The employee will need to change it. So that's an important thing to remember. Setting payment dates. Okay, payment dates. One of the good things about Nest, not applicable to all ours. So again, looking at Aviva, you can't do this on Aviva, which is frustrating. Nest, and you couldn't do it on Nest 12 months, 18 months ago. You can now define when you want that payment to be made. So payments in respect of pension contributions are due on the 22nd of the month, or the last working day prior to that. Nest, they treat it as the 21st, so they allow themselves an extra day. going back, they couldn't even tell you when it was going to be paid. It was within a 5-day window. So they've allowed that, but you can set the payment date. So if we upload a schedule and we know it's due on the 22nd of March, then we will upload it, forward date it to the 22nd of March so that we know that it will happen when it needs to happen, but it won't happen earlier, which, you know, I think is an important thing that you can do to ensure that those payments come out regularly, as opposed to even 12 months ago they were erratic, let's say, because there was no control. We couldn't exercise the control because the facility didn't exist. Now it does exist and we use it. So so selecting the payment date, we do that, and we select it for the due date being for Nest treated as 21st. That's when the direct debit payment will come out of your account. Client pension accountabilities. Yeah, so accountabilities, we're not expecting you to do it, but you are accountable for it. So if we're uploading these communications to My Pay window, then politely directing an employee to check it would be a good idea. So we're going to write to employees to confirm all of the things we discussed earlier, all of those four letters that an employee could get, telling them about postponement, whether they're eligible or not, and their option to opt in, and re-enrollment when it comes. So the writing to employees is part of the workflow, and beyond that, obviously Nest then communicate directly as well. The timings, I've kind of referred to them in passing. So just there are some that are set in stone and there are some that aren't set in stone. So joiner contribution files are uploaded after the payroll is closed. We are always treading a fine line in payroll between leaving a payroll open for potential changes that might happen. If we close it too early, then people are then making pay advances. If we close it too, it's a balancing act. We have to close it at some point in time. We used to leave it open forever and ever. Now we close it because we have to do other things. So once we close the payroll, we'll generate the joiner and contribution files, and they'll be uploaded after it's closed. Once we know nothing can change, basically, he said, hopefully. Typically that'll be the first or second week of the month. I say typically, it depends on where the month falls. It'll depend where the payroll falls within the month. If it's 15th of the month, 22nd of the month, 30th of the month, but it'll be the first or second week. And again, bearing in mind the other things that have to be done in tandem with it. So as I say, joiners must be processed after the employer letters are sent, but not very long after. So they got to be done together. But if there is a slight phasing issue, then we need to do our letters before Nest do theirs. Ours are a little more flexible than theirs, is what it boils down to. They're a pension, they're a pension provider. 30 days is 30 days, isn't it? It's not 31. We're a payroll provider. We know that real life gets in the way, and so we're a little more flexible, but we can't be too flexible. And contributions file has to be uploaded after the joiner file, so those things can't be done together. You have to add the joiners, and then there is a slight delay, then you add the contributions file. We have dabbled in the past our software, and there's some middleware that allows you to do it all together, but didn't have the necessary checks and balances to make sure it happens. So there are opportunities to improve that process a little bit. We've certainly got it on our radar to kind of make it slicker. It works, but it doesn't work as well as it probably could, and that's something that we definitely need to, is typically first or second week of the month good enough. When we're saying to you, we want our submission by X and we'll return it on Y and we'll pay the employee on Z, but typically first or second week we'll do this. And in our world, we'd like to be more precise, and I think that's what we're working on to make sure that we are more precise, because everything around pensions is precision. So Yeah. Communications, letters need to be sent within 42 days or 6 weeks of the assessment date. So that's the pension regulators saying you must do this by this. Bearing in mind the assessment date may well be the first of the month and you're running the payroll on the last day of the month, there's not a bigger window, as big a window as you would like there. So yeah, again, timing is everything. Making sure that that process is well dealt with and adhered to. The assessment date is the employee join date or the first day of first day following postponement. So we're not carrying out assessment until the postponement period has ended. Further stage of the communication is that the nest joiner pack will hit that employee, as I say, within 3 working days of us uploading the details to Nest. And then the employee must opt out within 1 month of receipt. So they've got to do something with it if they expect their contributions to be refunded. If they're not bothered about that, they don't need to act so quickly. They can stop at any point in time, and they can subsequently rejoin at any point in time. So, but they can only do that once in a 12-month period. So they can opt out, and then they can, oh, I made a bit of a mistake there, I want to opt in again. They can do that, and the communications will set that out, but they can't keep doing it. They can only do it, you know, once in a 12-month period. So they, you know, can't change their mind like the weather, I think is the key. So payments, contributions are due, as with all pensions, they're due by the 22nd of the month. So they need to be same date as your PAYE payments. They need to have cleared the account or be paid by direct debit on the 22nd of the month. And as I say, Nest use the 21st rather than the 22nd. So we can only forward date it to the 21st. If it was paid on the 22nd, it wouldn't be late. But because Nest provides the facility to do it on the 21st, we pay it on the 21st. You know, it's the same date every month, but it doesn't require any manual intervention. Employee refunds following opt-out are as soon as practical. So we'll get a notification of a refund at a point in time. Depending where we are in the pay cycle will depend whether that is refunded in that month or the following month. So potentially an employee may have a further deduction made from their pay after they've opted out. The opt-out will eventually be processed and they will get their money back, but it's, you know, it's obviously a cash flow, where's my money moment. So be aware that it's all dependent on timing. When did the employee make the decision? When did they notify it to Nest? When did we download that instruction? Because we won't do it immediately before payday once we've opened the pay run and the rest. So there is a time in there. One point I would make with employee refunds is if you see some money arrive in your bank account from Nest, which is what will happen potentially if they refund the money, don't ever be tempted to pay it to the employee. Yes, it is the employee's money. You may well know who it belongs to ultimately. We've certainly seen instances where an employer has paid it out. They will get it back through payroll. It's part of the record keeping process, you know, keeping everything recorded and auditable. Don't be tempted to make a payment that you know is a Nest refund directly. It will be done through payroll. We'll process it. It'll appear as a refund on their pay slip. It'll appear in their net pay. You'll pay it, and everything will be, reconciled and as it should be. So yeah, I'd mention that because it has happened in the past. Re-enrollment, again, briefly mentioned. So every 3 years, around 3 years, not exactly 3 years, but it can be exactly. So you take your step. We will generally use the 3-year anniversary of your staging date as the re-enrollment date. So it will be 3 years in general terms. Occasionally it might not be for whatever reason, but it will be around 3 years. And then, so we're going to reassess the employees who have opted out or left your workplace pension more than 12 months prior to the chosen date. So we've chosen a date, we've reassessed the workforce at that point in time, we've executed re-enrollment, and we have, we will have excluded anyone who left, for example, 3 months ago. If they just left the scheme, clearly it would be annoying for all concerned if they're suddenly put back in it. They'd question, why on earth does that happen? So luckily, legislation allows for a period of time for that instruction to be, valid, and 12 months being that period. Right to the employees who have been re-enrolled, same as very much the same as enrolled. A lot of the pension providers deal with it in exactly the same way. They don't differentiate between re-enrollment and enrollment. The communications will be the same for both. Nest does differentiate between the two, but yeah, they'll be re-enrolled, and they'll be told they've been re-enrolled. We'll upload the joiner information to Nest, same as before. They can't opt out until they're in it. Same rules apply. And then we'll process opt-outs and refund contributions through payroll in exactly the same way as a normal opt-out. And I get the feeling we're nearing the end now. Yes, so this is the final slide. So just revisiting what we've covered. It seemed like quite some time ago. Bloody hell, it's gone on longer than I thought. So escape through this then. Auto enrollment, the basics. Hopefully we've helped you to understand in some small way how your pension scheme works. Those decisions that would have been made at the beginning, either by yourself, your predecessors, your pension advisor, maybe, about the type of scheme. Board of Trustees, everyone would have been involved in that decision. But if ever you want to know what we're using as that default setting, we can let you know. We've talked extensively about assessment and enrolment. We talked about the contributions, how they're calculated, the different types of calculation involved, relief at source, etc. The communications involved from the employer via ourselves and from Nest. And we've talked about re-enrollment. I've shown you a very what the portal is there for, really. We wouldn't expect most employers to look at it very often. It's not the most user-friendly portal if you're looking for things you might like to look at. When did so-and-so's contributions start, or were they included in a schedule for, those sort of things are quite difficult to find. They're not intuitive, but most of it is there. But it's there and available, and does give you a picture. You can see who's opted out in the past and things like that. Delegated access, if you haven't got it already and you want it, we really should have it, to be fair, then we can go about giving you delegated access, reissuing those links if necessary to make sure that you're on and can see what's going on. And you will then enjoy the joys of notifications every time you get an email, or you will get emails. So brace yourselves for that. Pension management, hopefully giving you some understanding of the statutory communications, the life cycle of an employee, when they happen, and what they tell the employee. My pay window document delivery, that's really the key to, just like pay slips now. I mean, 12 months ago people were still receiving paper pay slips. The whole situation we've been in has accelerated that process. Everyone is now used to my pay window for document delivery, upload and download in most cases. It's another, it's a tool by which AE communications will be issued in future, or are already being issued. So that's your go-to for documents, and the employees go-to. Talk a little bit about the timeline, the things that are fixed, the things that are not so fixed, the things that we'll try and fix in the future. Re-enrollment again. I seem to put re-enrollment every slide just in case I missed it. And then declaration and redeclaration of compliance. Those are the documents that are completed and returned to the pension regulator to say, yes, we've done all the things that we need to do, either at the, on your staging date, or in the more likely scenario for everyone here, at the point in time you've reassessed your workforce, you've carried out re-enrollment, you tell the pension regulator what you've done. you tell him how many employees you had on your workforce at the time, how many people were already in a pension scheme, how many needed to be re-enrolled, etc., etc. And we should pick that up. The pension regulator website is reasonably good now. We've got everyone listed on it, and it tells us when the deadlines are approaching. So unless you've unless we haven't done it before, we'll pick it up naturally. But you will get, if you're the listed or the email contact point for the pension regulator, you'll get pension regulator paraphernalia delivered to your mailbox from about 9 months before the re-enrollment date, right up to 5 months afterwards. Yeah, just telling you need to do these things. Great thing with automated email is they keep on coming until it's done. They stop sending it once it's done. So, you know, we often get, you can check we're going to do it, don't get me wrong, but you may not get a reply. We quite often just we're going to do that. So yeah, I think that is it.